Welcome to Wealth Well Done. Together, we'll cover a wide range of important topics surrounding money and the impact it has on our lives. From the sophisticated and highly valuable planning techniques of the ultra-wealthy to the commonly underutilized biblical teachings. Together, we'll work to improve our relationship with money and our effectiveness in stewarding it well. Here's your host, Eric Scoville.
Okay, welcome to the 68th episode of the Wealth Well Done podcast, where we are examining these tactical, practical, and biblical aspects of your financial life and how do we help you do your wealth well done. Back again this week is Tom Costello, fresh wardrobe and all here for anyone who's actually watching on YouTube. Just joking. Last week we were talking much more macroeconomical about what's going on inside the U.S. with debt, with the Fed, and the economy. And now I want to switch gears into a discussion that is going to be informational for all, but it's going to very specifically help people who are accredited investors. So we are going to be talking about financial instruments here that require us to have that disclaimer on there saying this is not meant to be financial advice for you. This is just meant to be educational. We want you to consult your own financial team about how this applies to your personal situation. And also, some of the stuff we're going to be talking about here applies only to accredited investors. And so an accredited investor is someone who has a net worth of over $1 million, excluding their primary residence, or an income as an individual of $200,000, or a married filing jointly couple for $300,000 for each of the last 2 years, in anticipation of that moving forward. You can go look that up really easily to see if you are an accredited investor or not. But why that applies is a lot of these hedge funds that we're going to talk about, you can only invest in those if you are accredited. So that being said, and that's not some special registration you have to go get. It's just you need someone who is a licensed professional to sign off on that, a lawyer, an accountant, or a financial advisor. Okay, moving into from where we were talking last week, Tom. We were talking about the debt and where we're at. We talked a little bit about what happened inside the Japanese yen and this carry impact. And I told you, I wanted to talk a little bit about how hedge funds are managing their assets, which in some cases, even an individual who is not working with the hedge fund, who is not accredited, could glean something from the way that professional money managers are handling this. So let's talk a little bit about what a hedge fund is, and how it works. And then I guess I also want to establish your credibility in this realm. So sure. Tom, maybe you can do it better than I can, but talk a little bit about your background, your bio, the book that you've written, and then sure. We'll get into how hedge funds work.
I almost went and grabbed a copy to hold up, but it's out of reach at the moment. So I started as what was called a quant on the JP Morgan trading floor on the exotic swaps desk in the 1990s. I worked at JP Morgan, I worked at Deutsche Bank, I worked at Chase when there were two different banks, JP Morgan, Chase. Then I switched to the hedge fund side of the industry, which is, and I worked for three of the largest hedge funds in the world, War Capital, Caxton Associates, and Tudor Investments, where I managed money. I managed at my peak $500 million, and I never had a down year during any of that time in traditional finance. When I left Tudor Investments, I took a job as head of equity investing at about $1 billion quant-only fund, where I ran half the business. And that was a few years ago now. These days, I'm CIO of the hedge fund that you have a partnership in. It's called Bedrock Digital Assets, and invests only in cryptocurrency. So that's who I am and what I've done. There are one thing I would like to say is one of the things that when you hear people talking about hedge funds, they say they offer big sweeping statements. They'll say hedge funds underperform the market, which on average is actually true. They will say, hedge funds are, they do high frequency trading, or they only do this or that or the other thing. Or most of those things don't apply, and that's because there's a very, very big difference between what the highest performing hedge funds do and what the lowest performing hedge funds do. the shape of that distribution is what we call a Pareto distribution. So imagine we were to plot a chart of the wealth of everyone in the world. Jeff Bezos and Elon Musk would be up here, and then there'd be a bunch of VC guys down here, and then it would slowly slope like that, right? So it's real high on one side and slope down to the other. That's a Pareto distribution. And hedge fund returns are Pareto distributed. Most hedge funds are the smallest hedge funds. There's hundreds every year that open up and close and churn, and most of those are just retail guys that don't really understand the hedge fund industry. They don't know it. They don't have any connections in it. They said, hey, let's just go start a hedge fund. Most of those hedge funds don't make any money. And so when you take the average, since most of them lose money, even the people that make a lot of money, the Citadels and the whoever, even they don't make enough money to make up for all the losses of the other guys. But what they do in the top tier of the hedge fund industry, they make money every year. Citadel makes $3 or $4 billion a year and has done so every year for the last 25 years. Tudor hasn't lost money in 3 decades. There's probably 100 hedge funds at the top tier that just never lose money. And then there's others, once you get down to the middle tier, that maybe they have a down month or a couple of down months and then make it all up. And then, you get people like AQR where having a drawdown is part of the program, but over the long term, they make billions and billions and billions of dollars. So you have to be careful to differentiate between all hedge funds and the best performing hedge funds. Since that's where I got my training, generally speaking, I prefer to talk about what those guys are doing as opposed to what all the people are doing who don't make any money.
Okay. All right. Well, yeah. And on the back of your book, you talk about these sweeping generalizations about hedge funds as driving a bus on the Grand Prix, right? The Monte Carlo Grand Prix.
Yeah, I said it has as little in common with retail brokers scamming their blue collar clients as driving a bus on the New Jersey Turnpike does with trying to win the Monte Carlo Grand Prix.
Yeah, that's it.
In the top tier of the hedge fund industry, billions are spent every year, $240 billion a year they generate in revenue. The resources are extraordinary. The amount of money you have for hardware, for software, for you name it, any problem you've got, they've got a million ways to solve it, and they're going to make sure it gets solved very quickly.
Okay, so not all hedge funds are evil and cocaine.
No, on the contrary.
And all these other.
It's one of the few industries where you can't succeed if you're not honest. That isn't saying you're a good person. There are plenty of people in the hedge fund industry who are bad people. But if you aren't honest, you will never get to the top tier. The top tier of hedge fund managers are impeccably honest because everything they say can be verified. So there's no point in lying because everybody's going to check everything you say anyway. So
let's talk a little bit about why someone who's, whether we're talking about, we don't have to talk about someone at the top of that curve, a Bezos or a Musk, but someone who has millions, maybe not hundreds of millions, but someone who, $20 million net worth and up kind of person here, that as they're thinking about what a hedge fund is and they're realizing that maybe they need to have a different perspective on that. Why does someone like that, why would they use a hedge fund?
So the theory behind the service that a hedge fund provides is that it's going to, in an ideal circumstance, assuming that the person is actually able to accomplish their goals, the hedge fund manager, what they're going to deliver is a positive cash flow to you, the investor, that is uncorrelated with all your other investments. So maybe you've got, a shipping company, and your shipping company makes a lot of money. You've got an income from that. But you also have other investments. You have some tech stocks, and maybe you have some private equity, and they all produce a return. But if I'm going to give you a return that's uncorrelated to that, that means when your other investment is down, this will be up, so it won't be down as much. When it's up, maybe they'll both be up because it's both positive. So it generally reinforces your performance across the board. And that's what a hedge fund is designed to do. That's why it's called a hedge fund, actually, is because most of the top tier of the hedge fund industry is delivering its service to large institutions, to insurance companies, to pensions, to university endowments and family funds and others as well. And for them, that hedge fund represents a hedge. They can use that to hedge their downside and give them better return overall. That's the theory. Now, in order to do that, you're going to have to find somebody who can actually deliver.
Sure. Yeah, but these institutions or these net worth people are not, the idea of having a 30% drawdown in a year, that doesn't work. That doesn't work for them. Maybe because they just have a standard that says they can't, or maybe because of the way that they're set up in the structures, the leverage that they're using, that type of drawdown would be catastrophic. A pension fund can't have that type of drawdown, so they have to be protected here.
Exactly. Here's another way to think about it, and I thought about this one very carefully. I've been trying to figure out how to write this one down. Let's say you want to outperform Bitcoin. You want to buy Bitcoin, but you don't want all that volatility because there is a mountain of it. Okay, great. You go and spend $1 million on Bitcoin. Then you put it in a trust, and you get margin leverage on that. Say you borrow $500,000. You take that $500,000, you give it to the hedge fund that we run. Our hedge fund does not have high volatility. Our hedge fund has very low volatility, but it returns a small amount every day, right? So we can give you roughly, before fees, 30% a year. Maybe we're giving you 20% a year, but we're winning 85 days out of 100, right? So if we give you a 20% return on the $500,000 that you've borrowed against your $1 million in Bitcoin, you're now outperforming Bitcoin by 10%. You will find when it's down, it's not down as much. And when it's up by even more. That's a good example of how the hedge fund how a hedge fund delivers value.
Yeah, that's a great point. Okay, let's switch into digital currencies a little bit there, and then we'll come back to how Bedrock is a blend here. So we've been talking about government, and we're not getting into too many of these, I don't want to say crazy theories, because some of the theories that are out there that might seem crazy aren't maybe all that crazy.
Yeah, but all that it's the conspiracy theory means it hasn't been proven yet, right? So next year's fact is this year's conspiracy theory.
So let's just talk a little bit about where the world is at with digital currencies. That it came up a few years ago, and there was fears of, hey, everything's going to go digital. The government's going to be able to shut down my shut down my wallet here. I'm gonna have to get a digital wallet. What's that even mean? And then it falls out of the news, and so no one really talks about it anymore. What is going on inside governments and their involvement with digital currencies?
Well, I think there's a lot of reason to be encouraged. We spoke very briefly about the difference between the two political parties and what it means when they both say the same thing. So Donald Trump has said he wants to be a crypto presidency. He wants to support the industry. He wants it developed. He wants the U.S. to manage its regulation more carefully. Up to now, the U.S. has been exercising something called regulation by enforcement. So they won't tell you you're doing anything wrong. They'll just charge you with a crime once you've done things that they decide later are inappropriate. It's been a real problem for the U.S. crypto industry, and 80% of the industry is in the U.S. So Donald Trump has said he's going to open up crypto in the U.S. The Democrats have now said the same thing because it's turning out to be a popular political solution, but you have to wonder if they really mean it because they've had years to do something, and it's all been negative. It's all been anti-crypto. Either way, it's very difficult for me to imagine that we're not going to get something resembling cogent international regulation in the next couple of years. Up to now, it's been very hit and miss. We've had to we've had to react to that legally. We've had to internationalize our fund in a number of ways, all perfectly legal and appropriate and the kind of thing that the hedge fund industry has always done. But it's a cost. It's a burden to do it that we would prefer not to do. What we would like would be that all the big banks support crypto just like they support trading equities or commodities or swaps or anything else. That would be the ideal circumstance. Until we get there, we found other ways to solve those problems. And that's one of the things that investing in a hedge fund can do for you, is it gives you some domain expertise in a space. If you wanted to invest in the crypto industry, you weren't really sure how, you weren't really sure what was allowed, you wanted to do something maybe that was a little bit more sophisticated than just buying Bitcoin and seeing what happens, the hedge fund industry can potentially do those things for you. And ours is a good example of what that looks like.
Let's go ahead and talk about that. So what does Bedrock do and what's unique about it?
Well, there's a couple
and I guess I just want to throw this out there, that another one of those disclaimers that I have an interest in this. I am a co-owner here. And so, yes, if someone wants to understand more, we will absolutely share that with you. I have a conflict of interest, but I also have a bias toward this, and you're going to understand why. But we want to lay it all out there as open and honest as could possibly be. That way, if someone's going to invest, they can make the right decision there. Only for accredited investors here, though. All right.
So I have something that most people in the crypto hedge fund industry do not, and that is 35 years experience in traditional finance and a complete understanding of how leverage and hedging actually works. Most of the hedge funds in the cryptocurrency industry are very, very, very smart guys, but they have limited experience. 3 to 5 years is about average, as near as I can tell. There are a couple others, maybe a half a dozen, that have people more like me in charge of them, but not many. They're a minority in the industry. So that's one thing that we have. Another thing we're doing is that we are not asking you to pay us fees to buy Bitcoin for you. What we are doing is a structured fund that uses derivatives, that hedges away all the volatility in the cryptocurrency industry. We engage in what's called a levered carry strategy. So we have a long position and we have a short position, and they hedge each other. So if the market goes up or the market goes down, we don't care.
And long and short just means, for anyone?
How do you even explain a short trade? It means we borrow one and sell it, and then we buy one, but the two of them have equivalent value. They rise and fall in the market at the same time. So imagine that you were buying the S&P 500, but you also sold the spider. So you bought the S&P 500 stocks and you sold the spider. You own them here long on one side, and you owe them here short on the other. So as the market goes up and down, they would hedge each other. So that's how our strategy works.
Yep,
the only difference from that and us is that on our long positions, we collect interest. We're paid a fee, right? Just like if we had lent money, we collect interest on that. Any instrument that we use to hedge it, we collect interest on that too. So we're getting paid to hold the long, and we're getting paid to hold the short. You combine them, you end up with a very, very nice return. It's what's called an accrual strategy. You don't make a lot of money every day, but you make it almost every day. So every day you add a little bit more and a little bit more and a little bit more and a little bit more. And the price just goes tick, 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 right? Over time, it proves to be a very, very reliable way to make a substantial amount of money, because the amount of interest we're being paid is extraordinary since it's such an illiquid market. It's an inefficient market.
I just think that we'll just keep grabbing stuff because there's a lot to explain to this. What does it mean it's an inefficient market?
So an efficient market is one where all the available information on the value of that asset is appreciated instantly. So if you look at the S&P 500 right before the market opens, right? A lot of things happened from the time the market closed to the time it opens. At 9:30 and 1 second, the price of the S&P 500 does that. And that's the S&P 500 valuing in all of that information that happened over the last 20 hours or whatever since it's been closed, right? Over the course of a weekend, it might go even further because it's been closed for 2 days. There's more information. So that's literally appreciating that information. That's what that market does, is it discounts all that information, figures out how it will impact pricing, and the market moves instantly. Crypto doesn't work like that because not that many people are investing in it yet. In crypto, it's only experts, only people that know how to navigate the various international markets, and mostly hedge funds. There are some people internationally who do it, but they're a very, very small portion of the market overall. So the rates that we collect are very, very high relative to what you could get in any other market. You can do a carry trade in the traditional finance industry. I mentioned last week when we spoke, I mentioned the Japanese carry trade because the Japanese central bank was artificially keeping interest rates low. People would go there and borrow yen and then use that yen to buy U.S. stocks. And a couple of weeks ago, they threatened to raise rates, so that whole trade got unwound by hedge funds right away. Well, that's a similar sort of thing. You borrow money where it's cheap, and you lend it where you're going to get it richly, right? Mm-hmm. We borrow dollars, we lend it in the cryptocurrency industry, and we get a high return back. So on average, our top line return before fees and expenses and everything is, on an annualized basis, probably going to be about 35%. For investors, post fees, in most cases, that means 22%, something along those lines, maybe a little bit less. It depends. It depends on a bunch of things. We'd need to talk to you about it.
Right, and that doesn't mean that we're taking, then in that case, 13% fees. That there's a
no. It's none of those things. What we're talking about is, we take out interest, we take out exchange fees, for transactions. We have legal fees that are part of our expenses. We don't do it. We're audited and everything. We can give you a complete audit trail. We can let you see all the paperwork. We're SEC registered. We're well within the lines in terms of doing everything the right way. It's the only way we would ever do it.
Right. So when someone, I guess the other thing I was going to say was time frame. So we put this in place. The returns that you're talking about, that is dating back to November 1st. So we have been executing this trade, which was a tremendous lift, mostly on your part and a couple of our partners as well. But the lift to get this trade in place inside the cryptocurrency industry was a big deal because of the way that the industry is just not matured yet to the point like a traditional finance industry, which obviously makes sense.
It's not just most of the hedge funds are run by someone with 3 to 5 years experience. Most of the brokers in the industry aren't really that sophisticated either. So in order to run this strategy, I need somebody with the sophistication of a big prime brokerage bank. That's been a little hard to come by.
Yeah. But now
we did find it, and we're running now. So
now what those returns are actuals here for the last, what would be closing in on over 9 months now. 9.5 months in. Let's talk a little bit about the volatility of this. So we have people now using this strategy as a means of cash flow because they recognize that they can make an investment here, see the stability inside the fund, and they just know that they can pull money out. Every quarter they can take a distribution out of it, and they're getting
we have agreements in place where every time they redeem their profits every quarter. Yeah.
So,
which we're happy
heck of a lot bigger return than what you get from a bank to leave it there, or from a treasury, at least as it stands right now. Again, all that needs to be, checked, and you go through your due diligence there.
Yeah, carefully caveated. But the simple fact is, a carry trade in this market is very, very high yielding, and a carry trade typically. A levered carry trade in the currency space is very, very reliable as well. It's just it doesn't yield anywhere near as much. So because we're getting a high yield as well as being really reliable, our Sharpe ratio, which is a metric that we use to describe risk-adjusted return, it's so high. We have other investors that can't believe it's possible. I didn't know it was possible to have an enduring strategy with a Sharpe ratio this high. And that's because I'd mostly been working in mature markets. Crypto is really unique in that it's grown really rapidly, but it's not really very mature yet. It's still a very young market.
We've had to explain to other people why the Sharpe is, why it can be reliable, reliably even factored in because it's so unusually high.
Yeah, it's roughly three times the highest reasonable Sharpe ratio I'd heard of in 20 years.
Yeah,
I've seen some strategy like Sharpe ratio doesn't tell you everything. Sharpe ratio tells you a thing, right? It's one way of examining the risk-adjusted return of a strategy, and ours is very high. Our other metrics for risk-adjusted return are also very high. So, we shouldn't get too obsessed with it. It's statistics like that are easy to misunderstand. They're easy to overemphasize. With that said, we're making a lot of money and taking very little risk to produce it. And that's what it really means.
So will you explain a little bit of just what a carry trade is? I guess again, because I am anticipating that many listeners who haven't been deep involved with this for the last few years are going to need a couple runs through. So talk maybe about the Turkish lira example here that we traditionally use.
This is in the traditional currency markets, a carry trade is something engaged in to the tune of tens of billions of dollars every year by large institutions. It's not every day. It's not the kind of thing that you have, access to retail for. But among institutions, it's a very, very common trade. And the best example is one where you talk about Turkish lira. So suppose we were borrowing US dollars right now. One way that we could borrow US dollars would be we'd short US treasuries. Okay? So if we sell the treasury today, that means we'll need to pay the interest on that treasury, but we get the amount of those notional dollars today. So we sell 10 million in US treasuries. We've got 10 million, but we're going to owe interest over that, right? We take that 10 million and we buy Turkish lira treasuries, right? The treasury bond from the Turkish government. Now, the interest rates and the inflation rates in Turkey are astronomical compared to the US. So we just borrowed money at, let's call it 5%. We're going to lend it to the Turkish government by buying their bonds at something like 25%. That means we're going to get 20% interest rate differential. And here's the problem. That bond, that Turkish bond, is going to pay us in Turkish lira. And we're going to need to convert that back to US dollars. If we look forward and just wait for that to happen, we don't know what the currency rate is going to be. So what we're going to do is we're going to fix that rate right now using something called a currency forward. We know how many Turkish lira we're going to get. That's a fixed income trade. So we know how much interest it's going to pay. So we know how much we're going to need to convert back to US dollars. So we buy a currency forward for 90 days out, say, and that we pay, maybe 18% for, right? So now we're getting 25, we're paying 18.
I want to jump in here just to help people stay along with this. So we're borrowing from the U.S. at a lower rate. We're lending to Turkey here at a higher rate.
That's right.
And now there is a specific instrument that's common inside institutional trading. There's a specific instrument that will allow us to basically hedge the difference in the fluctuations in price here. And that's what you just
the currency value. That's right. And in the end, we're probably going to end up with, a 2% differential. And every day that goes by over that next 90 days, we get 1/90th of that 2% of the 10 million, which is real money, right? So we're going to collect that. Market can go up, market could go down. Turkish lira does this, doesn't matter. We're already hedged. Interest rates go up or down or change or inflation. We're hedged against everything. That's the beauty of it.
So Turkish lira collapses.
It doesn't matter because we've already got our contract. Exactly.
You have a contract in place that if the Turkish is almost like an insurance contract, that's not what it is here, but similar to the way a farmer, what a hedge used to be when a farmer would hedge against the price, of corn here, that type of instrument is available for currencies here. So we know that if the Turkish lira collapses, or the US dollar collapses, or whatever, anything happens here, that we are going to, it doesn't affect us in this trade because we have an instrument that insulates us from the market moves.
And at the end of 90 days, we'll know as soon as we buy that contract, as soon as we're done paying for that insurance, we'll know right away how much we'll have at the end of that 90 days. And it's going to be a positive number. Now, is it going to be the kind of huge rate that we're getting in the crypto industry? No, because the Turkish lira exchange rate, that's a very efficient market, very efficient. As things change in Turkey, the Turkish exchange rate to dollars oscillates wildly. So it's a very, very efficient market with a lot of people looking at it. Not that many people looking at the cryptocurrency market. And because we're in a market it's got plenty of size, it's not very evolved yet. Not many people are doing this trade. We're getting a really big payout on it.
Yeah. Okay.
So it's the same theory. It's fully hedged. Markets go up, markets go down. We don't care. What's called volatility goes up or down. We don't really care. We're hedged, fully structured. We know exactly what we're going to get. And that's overstating it just a little. I'll have to straighten that out with anybody that actually comes in and talks to us about it. But we can predict with a high degree of accuracy what we can expect from the trade.
Yeah. Okay. And so then for someone who has decided to listen to this episode anyways, but the moment you say cryptocurrency at the beginning, they went ahead and moderately tuned out. What is the difference between this and cryptocurrency?
Well, people are afraid of cryptocurrency for a number of different reasons, in my experience. One is they just don't understand it, or they say they don't believe in cryptocurrency. Well, I don't believe in cryptocurrency either. I believe there's a thing called cryptocurrency and people want to buy it, right? But do I believe this is going to be the replacement for the dollar? Well, no, that's not what this fund does. The interest that we collect on these positions, the long and short position, that interest is a product of transaction volume. So when people buy and sell crypto in the various exchanges, they pay a fee. That fee is paid to us through this process. That's our interest that we collect. I do very much believe that a lot of people are trading cryptocurrency, whether it's a good investment over the long term or bad, whether it's going to replace dollars or not. I don't know. There are some people who are afraid of cryptocurrency because they think that a lot of the people in the industry are dishonest. I assure you, we are not dishonest. We're an SEC-registered hedge fund. We do everything the right way. I built a career on being an honest person. A lot of people tell you I'm fairly disagreeable, but none of them will tell you I'm dishonest. And that's the fact. So, this is a strategy that is employed at the top tier of the hedge funds very, very commonly. It's one that I learned many years ago, actually from the guy who invented it, or at least a guy who claimed to invent it many, many years before, and who had credibility for that claim. And, it's just doing it in a new market in a way that's going to yield quite a bit of return. Our performance on it has really been just great. We have, months where we make 4%. We have months where we make 0.01%. We haven't had any months where we've lost money on it. Not one. We have had days. We've had periods of a couple of days where we have what's called a drawdown. But our peak drawdown, our worst drawdown in the history of the strategy, is 1.4%. So that means at our absolute worst moment, we went from being a 100% new high down to 98.6%. And then 8 days later, we went back up to a new high. That's been our worst performance since we started running the strategy. It's pretty reliable.
It is, and to think of that inside the crypto industry is just something that people need an open mind to even wrap their head around. Because
I had to educate a lot of people in the industry to make it happen. Let me tell you, it was not an easy. It took us a year. We'd conceived of it a year prior to actually deploying the strategy.
So if someone wants to do some more research into this, obviously you can reach out to me. You can reach out to Tom. You can find his book, and we can also, and we'll put links in the chat for that. But the You can also go to, there are different hedge fund databases and different private investment databases that you can use. Barclay Hedge, With Intelligence, their Preqin are a few of the most popular ones. There are some others out there as well. Dakota has one, and you can go there and look at these all of these funds that report their performance, and they don't get to just self-report any number that they make up. They have their administration or their auditors report these performances, and that is then checked. And so that's where that our hedge funds are performed there. I, as a financial advisor, go in and look at our returns here for Bedrock compared to the other funds out there. And we're sitting on something incredibly unique and special here in that realm. Like you said, a Sharpe ratio 3 times higher than anything you would ever expect to see in the traditional equity space. So
there's one more thing you remind me, Eric, that we should probably bring up. So much of the hedge fund industry is designed to facilitate trust. So we don't do our own accounting. Our accounting is done by a third-party company called an administrator, right? They validate all our numbers. None of our numbers come from us. We literally have someone looking over our shoulder every day to make sure that the number that we report every day is correct. Those numbers, their numbers, are audited at the end of every year. So we have an auditor who checks them, they check us. We have brokers who pass information back to them so that the auditors can get it, that
right.
confirm all. The entire structure of the industry is designed so that the person who's interested can see that this has all been verified. It's all been, confirmed by a party who, we do pay our admin. We don't pay them very much, but that's their job, is to make sure that our numbers are accurate. So there's something to be said for that. You don't see that in many industries. That's
right. And so if someone wants to, if an individual investor is looking for hedge funds that they can start doing their own research on, if in addition to ours or instead of ours, their Interactive Brokers is a place that you can go and have an account there, and you can look at the funds that they offer as well. There are hedge funds you can invest in through Schwab, Midland Trust. I think they've got a new name now, but that's who we've used for clients who want to invest through their IRAs. And again, all of that needs to be determined. The thought of someone investing their 401k or their IRA into crypto, that seems scary until you go ahead and validate that with a more thorough thought process. So we would want to encourage people to do that. But what I want to do and what I've set out to do with this is help people understand some of the tactical ways that ultra wealthy people are managing their money. The Bible tells us that we're supposed to be innocent as doves, but shrewd as serpents. And one of the things we need to understand, and if we're only speaking to just conservative Christians here, which we're not, but if we're only speaking to them who say, listen, I don't need any of that stuff. I just, I'll keep it, plain and simple. Well, the reality is the ultra high net worth are not keeping it plain and simple. They are trying to find ways that they can maximize value. They're trying to find ways where they can get an outsized return for the risk that they're willing to take on. That disproportion inside of that ratio is what a hedge fund is striving to produce. And so they're looking to they're looking to diversify across different asset classes. And so all of that is part of what someone who is managing ultra high net worth and stewarding that well would be looking to do. We'd want you to look at our strategy as well as others. We want you to understand that that you don't just need to sit there and complain about the government or complain about the governments of the world. There are proactive things that you can do to manage your assets better. Tom, you got something there?
I'm just thinking to myself, we're happy to listen to your complaints about the government too. Believe me, we've got a bunch of our own.
Yeah, we can join in with you on that.
Yeah, and I've spent most of my life working for billionaires. The most of my career has been spent working for 3 very relatively famous billionaires, and they're good guys. They were honorable men. But in the capital markets, it's sort of like being in a boxing match, right? If I go out on the street and I just punch somebody in the face, that's obviously wrong. If I go into the ring and I punch somebody in the face, it's sort of expected. That's how the rules are set up. And the capital markets are kind of like that. It isn't about, you don't want to lie. You can't lie, not realistically, not in our industry, because if you found out, you're finished. So it doesn't make any sense. But within the rules, you can do things that optimize things, right? And one of the things I've often said is that the industry is the most directly competitive environment in the world since the Romans closed the gladiator pits. So what our hedge fund does, what it really does, and what I've learned to do over the last 30 years, is to find people who are making mistakes and then find a way to capitalize on their mistakes. This huge volatility of crypto is a mistake. It was engineered into the system in a lot of complicated ways that I can explain if anybody wants to call up and we can talk about it. But it's a mistake. So what I want to do is when other people create that volatility, I want to profit from them making mistakes. And that's literally what we're doing. We hedge it all away. All of it we give away. We hedge away the volatility. Our strategy goes up a little bit every day, $1,000 a day or whatever it is, tiny little percentage every day. And then you go back and you look, it's really added up. We're well into double digits for the year, and we've still got several months left. Our best performing months typically are the last 3 of the year. So,
okay. Tom Costello, author, longtime quant. Thank you for all that you have provided here the last couple episodes. I hope that
great pleasure.
Yeah. I hope the listeners have been allowed to expand their understanding of the markets, of the economy, and also what power they have to do something about that. So, listeners, thank you very much. Hope you guys have a great week.
You too. Cheers.
Thank you again for listening to Wealth Well Done. Be sure to subscribe to the show on your favorite podcast player, and together we'll continue to improve our relationship with money and our effectiveness in stewarding it well.